All right, good morning, everybody. Audrey, thanks for being here this morning. So appreciate it. Everybody, you're in the Matrix with Audrey Veltri. I'm pronouncing that right, Audrey? Yes, okay, just making sure. And as many of you know, the purpose of our calls with respect to In the Matrix is really about introducing you to the people, their insights, and their expertise to better help us navigate the realms of money management, money mindset, and money motive. And for those of you not familiar with the Matrix, it's when these three disciplines come together: money management, understanding exactly how much we need to make so that we can invest properly, we can save properly, we can spend properly, as well as then money mindset, understanding the developmental and the inherited programming that's blocking that magic number from happening. And the third is money motive, which is about getting into alignment with why making this magic number is so important. So quite honestly, this is where Audrey had me, was the financial alignment piece of it. So excited to speak to her about that today. So today with us, we have Audrey Veltri, and Audrey and I go way back. We go back to 2019. It was summer, and one of our good friends that we both have in common thought that it would be wise for Audrey and I to meet, and it absolutely was. And we've been looking for the right opportunity to collaborate, and here it is. COVID is that opportunity and is a catalyst for connections. So thank you, Audrey, again, for being here. Now, bear with me because I am actually going to read Audrey's bio. I think it's important that you get a sense of who is speaking with us today. I'm going to read it from LinkedIn because there's a lot of great information here. So you're going to see exactly why I fell in love with Audrey and why I think she's the perfect person for this call today. Financial planning goes beyond your account balances. Our vision is to provide trusted financial advice so that you can embrace life's possibilities. Audrey has a passion for delivering financial confidence. She encourages clients to take active participation in their financial future and fosters this through education and leadership. She was the recipient of the Calgary Learns Facilitator of the Year Award in 2002. And has been recognized for her dedication to wealth planning, earning the Pillar Platinum Award in 2018 and Pillar Award in 2019. She leads a wealth management practice that centers on partnering with women, professional corporations, and businesses to achieve their personal economic revolution. A segment of her practice focuses on planning strategies for families supporting a dependent with a disability. She holds multiple volunteer and board positions that involve or improve and strengthen lives in the community, including a position with the international organization BPW. That stands for what, Audrey? Oh, sorry, you cut out. You're on mute. There you go.
I muted myself while you were talking there. It's the Business Professional Women's Organization.
Beautiful. Thank you. And locally, she supports organizations like DDRC.
That's the Developmental Disability Resource Center here in Calgary.
Beautiful. Autism Calgary, AC, and Between Friends, BF.
So many acronyms in my world.
So many, I know. And here we go. Audrey passionately believes that the most important part of wealth is we. So thank you for joining us this morning, Audrey, and being a part of our We collective here to learn a little bit more about investing. So
well, thank you for having me. It's been a long time coming, like you said, and I'm just excited to see your face and to I know we're not able to get together in person anymore, but this is a good close second. So thanks for having me.
There you go. Well, so let's get started. I know that in speaking with many of the members that are actually members of the Matrix who have gone through this program, COVID right now, a lot of people are excited to start investing, but perhaps in the past, I don't want to say they were hiding from it. They might have put in some investment somewhere. a lot of people, a lot of our audience had some mutual funds, maybe some pension plans built up, but a lot of people have been very intimidated around the concept of investing, how to go about it. And I think this is a great opportunity, especially why you're here today, is you are a friendly, you're here about empowering and educating people. So maybe can we just strip it way down, because I know a lot of people are intimidated to ask some of these questions. So I'm gonna step up and ask them so that we just know exactly what we're talking about when we're talking about investing, because there's multiple ways that we can invest. Today we're going to talk about the stock market, but can you just clarify the whole idea of investing for us to start off with?
Yeah, I think one of the first things you need to do when you're just getting started with investing is to do a little bit of research on the different ways that you can invest, because there's many, many different ways, and none of them are right or wrong. They're just right or wrong for you. And you need to understand what type of investor you are right now. Maybe you have aspirations of being a different type of investor in the future, but you need to start somewhere. And so I always tell people who are looking at getting started with investing to really start to understand, before you even put $1 into the market, to understand, well, what kind of investor am I? Where's my knowledge based? Do I understand what the market is and how it operates? Do I understand, different types of investments? Because there's tons of different types. There's the actual stocks or equities. There's bonds and fixed income. There's ETFs, and I'm not going to label them all off because we're going to get into those as we have a discussion here. And then not only are there different types of investments, there's different vehicles that you can invest in, and we're going to talk about what those are today, because those can impact things like when we can take our money out, how we take our money out, the tax implications of taking our money out, and how they can even grow inside those vehicles, right? So, we want to start there. We want to start with understanding those steps. I did want to share just something about why now some people are saying now is a good opportunity. Because a lot of people are saying, oh my gosh, everything's on sale, stocks are on sale, because we're in this correction. So I just want to go back. I'm just going to share my screen with everyone really quick here. I want to go back 11 years. So tell me when you can see this.
There it is.
Excellent. So March 9th in 2009, the S&P 500, which is the stock market, for those of us who aren't clear on what the S&P 500 is, it's a market index. And so it was down 50%, which was a drastic. Everyone kind of remembers 2008 was the the financial crisis of 2008. And by March 9th, 2009, the market had plummeted 50%. And the belief at that time was that capitalism had ultimately failed. Okay, so investors, professionals, the media, everyone was up in arms and saying, capitalism has failed. There is no possible way that we can see any upside performance. Economies are going to be stagnant. It was a crisis, an ultimate crisis. Sounds kind of familiar to some of what we're hearing right now. And it was supported by this belief that we were bailing out the global financial institutions with taxpayer dollars, right? So we were socializing a system. Again, there's some parallels that we can draw to today, how we are bailing out the health system with a COVID package, right? Billions of dollars or trillions in the United States. Essentially a socialist sort of, and I'm not getting into politics today, but it's the same. So you can draw that parallel that, we're influxing all this government money into a system, taxpayer dollars. And a lot of people feel that, okay, that's the end of capitalism, that markets and economies won't be able to grow. But if you look at that chart from 2000 there, you can see for the last 11 years, we've had one of the largest economic expansions in history. So the stock market actually rose from that date 350%. So that's what people are talking about right now as the opportunity. anytime the market is in one of those recessionary corrections, and I'm reluctant to use the word recession, but corrections, we are then presented with an opportunity that it's going to go back up. Because over history, we have been shown that that's the pattern.
So can I ask right now, where are we sitting now? In 2008, we dropped 50 points here. Where are we sitting now relative to where we were 2008?
It was about a 30, let's call it 35% drop. It was a little less than that, but yeah, so it was a correction. Yeah, it was felt by a lot of people. So anytime you have that, and it was very, very swift. It was a very, very swift, it was about 2 weeks, and we were, everyone was kind of, our heads were spinning. It was a very swift correction that was felt in the market.
So 2008, it was 50.
Yeah.
And now in COVID, it was only 35. We didn't drop to the levels that we dropped in 2008.
No, I think it was, and we don't know if we're at the bottom, right? So that's the other thing. So right now we seem to be bouncing in what we would refer to a resistance band. So there's like the elastic, and we're kind of doing this thing, but we will see what happens moving forward over the next couple of weeks as we navigate COVID.
Right.
So basically it's like a loop, right? The stock market works on a loop with our lives. It's based on the economy, right? What we're doing, how we as citizens, as people can spend our money. And so if we feel confident and, we can go out and buy that new pair of shoes, and we're getting our paychecks, our raises, we're keeping up with inflation. As people, we feel very confident in the economy and in our position in it. And so we're, consumer confidence is high. And what that enables people to do is it goes out and shops and buy things and drives the economy, drives production, drives oil, drives everything, right? And when economies are running strong like that, companies are making profit, right? Because we're buying their stuff or we're needing their stuff. And I'm greatly simplifying economics right now into 3 circles, but for today, let's just keep it like that. So economies are strong, the companies are performing well, they have good earnings, right? They're making a profit. When companies are making a profit, the market views them as being positive and they want to buy in them. They want part of that profit, because that's what a stock is. A stock is ownership in a company. So when Apple is making lots of phones and making lots of money, I want to own Apple because I want some of that profit. I want a piece of that pie.
Right. Okay.
That's when all's going well. So what COVID did is it interrupted economies, right? It said supply chains are going to be affected. Oil, we also had a bit of an oil crisis going on. The Saudi Arabia and Russia were fighting over oil, which drove oil down. China, one of the largest manufacturers, bigger producers in the world, were impacted by COVID first. So everything kind of went to a halt. So when that circle up here of the economy, the companies were maybe not going to make profit. We didn't know. We were all saying, oh my gosh, what's this going to do to companies? So then consumer confidence is impacted. We all stopped spending money, and not, just us, but company, everyone. They tightened up the purse strings and stopped spending money, which further, drives or impacts economies. And so what does the stock market do in reaction to those two circles? Because the stock market is a reactionary item to what's happening with those two circles. So it said, I also don't have confidence in these things. Sorry, getting a bit of a frog in my throat here. So that's why we saw that correction. That's what creates that.
So then just to clarify kind of where we're at, we understand now that a stock is a share in a company, right? It's an equity position in a company. And then we are going to either financially benefit or lose money based on the performance of that company. So we've got the performance of what that company is doing, and as it's increasing value, right? Or it's the perception of what that company is doing, probably even more likely. And where now we have seen the dip is because people have pulled out of those investments, and because they were afraid, the perception was that either I want to hoard my money, maybe had nothing to do with the company itself, but I want to take my money out, protect it. So this is where we're seeing the decline in the value of the stock, right? And this is where the opportunity exists right now because of people's fear and perception of what the market may do or the company may do. They started letting everything go, which devalued the price. So now, as I think I put it in the marketing piece, it's like a basement sale at Barney's.
Yes.
You've got all of these extremely valuable businesses that really, for the most part, and I'm not going to get you to speculate, but they can rebound. We didn't even hit the levels that 2008 hit, is what I'm hearing you say right now. We haven't gone as deep as where we were in 2008, and we managed to correct very quickly. As you said, well, we managed in 10 years, we were able to get to a very different level there. So now that we can understand stocks and the value of a stock and where that value comes from and how it's perception and reactionary, which is key, I think, in this point. It's not about the actual value of the company itself. It's what people are thinking the value is worth. What are the markets? How do markets work specifically? Because there's tons of markets too, right?
Yeah, I'm just going to back up just one little bit because there's something that was said just in that sentence that I just want to clarify. So the stock market, or when you're investing, is very emotionally driven by people because we're the ones making the decisions. So it's an emotional decision often that we make about whether to invest or whether to not. And what we want to do, what good savvy investors do, is they remove emotion. So when everyone else is selling stock, right, as things are going down, people are selling that. They're saying, I want out, I want out. For every seller, there is a buyer. That's how it works. So so everyone has a different feeling or a different thought on when the market's going to reach the bottom, when it's a good time to buy, when it's a good time to sell. So, while emotion sort of drives that, those waves, that's what the opportunity is. The opportunity for investors is to remove emotion and make good decisions about your investments that are sort of counterintuitive, to be honest. So I just wanted to clarify that. I wanted to go back to and talk about what is a stock a little bit more, and talk about a term that's really important called diversification, right, within your stock portfolio. And I also want to talk about fixed income, which is another type of investment. So I'm going to share my screen again here real quick.
I'm just going to, 1 second, because you cut out there for a second. So the word Audrey was using there was diversification. That's what she's going to walk us through. Okay.
We all hear the word diversification, and don't put your eggs all in one basket. That's kind of what we're talking about here. So I have on the screen equities and fixed income. Those are the two, two sort of ways you can invest. I mean, there's a lot of different ways, but you can invest in stocks, or what we refer to as equities, or you can invest in fixed income, which is essentially debt. So these are the two ways that a company raises capital for itself. One, on the equities or the stock side, they say, we want some capital, we want some money, and so what we're going to do is we're going to sell a portion of our ownership. So Tanya, you could say, yeah, I want to buy into Apple, right? And I want to own a little piece of Apple. So you would buy stock. And so as Apple, as I said, as Apple's profit goes up, so does the value of your stock. If Apple's profit dropped, so would the value of your stock. So that's equities. And we want to make sure when we're building an equity portfolio that we own not just Apple, because if that's all we own, then our entire, when Apple went up, we went up. When Apple went down, we would go down. And so we want to own across commodities, consumer staples, transportation, there's the financial services industry, there's manufacturing, there's, oil and gas sector, there's technology, there's health and pharmaceuticals, there's all different sectors of equities. And then there's further geographic diversification, not all in Canada, not all in the US. So when you're looking at that, you want to be able to build a diversified stock portfolio, which can take a substantial amount of money. If you think about it, you can't own just one, you're going to own one share of Apple, one share of Facebook, one share of RBC Bank, one share of Suncor, right? Like you have to have a decent amount of capital to really start deploying it in a diversified stock strategy.
Can I ask you a question there? And maybe you're going to speak to this later, so let me know. When we're looking at buying stocks, I know that sometimes there's this idea of buy what you know, buy what you're familiar with, right? You know Starbucks, you see it, you're intimately involved with it. Maybe it's a wine and varietals. But if we're adhering to that logic, then that would somewhat remove us from some of these other sectors, right? Because it might not be transportation, it might not be commodities. So what are your thoughts on that? Because then that gets people into areas that they're not comfortable with. Are there stepping stones here, do you think?
Yeah, from my perspective, and this is something that we're going to talk about later, to have when you're just starting and you want a diversified strategy, sometimes it's better to buy a basket, right? So that would be like a mutual fund or an ETF, and we'll kind of talk about what those things are, right? They have some diversification already built into them. And when people are just starting out, again, this is where we want to go and take a look at what kind of an investor are we? Are we wanting to do this ourselves, or do we know enough about reading consumer, like company balance sheets and understanding their price earnings? And do we know that we're investing in a good company? Can we read their financial statements and make a good decision? And I get invest in what you know. Starbucks is a great company. Everyone's buying coffee. They're not going under anytime soon. But that might not get you the furthest ahead that you need to be, right? If you just own just Starbucks because you know it and you like it. I love Starbucks too, right? But you want to make sure that, giants have fallen, right? We've seen huge companies fall before. So to have all your eggs in the one basket, I wouldn't recommend that as a strategy.
Okay.
So just to go back to fixed income is debt. So another way that a company will raise money for itself is to issue debt, issue bonds. So rather than owning a piece of the company borrows your money. Right? So they say, oh, thanks for your money. I'm going to borrow that for you. I'm going to issue this bond and I'm going to give you an interest rate. And at the end of the term, I'm going to borrow it for 1 year, 2 years, 10 years, 100 years. And the government of Canada just issued 100-year bonds. So, it's based on a term. After that term, they will give you your full capital back. So let's say they borrowed $1,000 from you for a 2-year term. At the end of 2 years, they're going to give you your $1,000 back, and then they've been paying you interest along the way. So that's fixed income. That's the kind of the bond market.
So can I ask 2 quick questions there? Sure. So obviously the interest would probably be less then, right? Because the risk is obviously mitigated. So you're not going to make the same return that you would on an equity piece.
Potential return on an equity piece.
Potential return. Thank you. Yeah. And so, so one of the questions I have here is that I know in the past we have heard that oftentimes when we are investing, people will take a portion of that investment as a diversified portfolio, put it into a fixed income because it is low risk, where you might have some equities that are higher risk. But I've also been hearing investors say that fixed income is the equivalent of liquid cash. It's the equivalent of money that you have immediate access to in the event that you need cash to be able to live at home, right? But what I'm hearing you say is that typically there's a term attached to it. So it isn't necessarily liquid cash. You can't just go in and say, okay, I'm taking back my loan. I need my money back. Is that right?
Well, it depends on the type of fixed income that we're speaking about. So
Gotcha.
There are, the bonds trade on the market too, so they can be liquid. So gotcha. Don't think of it, I'm just trying to explain what a bond would be, but other people buy and sell and trade bonds. So it is, whoever said that was correct in some cases, that it can be liquid. It depends on the arrangement.
this is where you, a financial advisor, step in to really make sure that you understand if you're starting to invest this into a fixed income fund, out of that fixed income fund, what piece of it can you liquidate right away so that you do have access to that cash versus which ones have terms attached, right? So you're balancing everything out.
Yeah, and what I'm the other part that I'm trying to get at is if you think of your investment portfolio like a vehicle that's trying to get you somewhere,
Yes.
equities is the gas pedal, right?
Okay.
You can speed up. It has a greater potential for a greater, it has a potential for a greater return. With greater return comes greater potential for risk,
Yeah.
right? So equities are that gas pedal that can potentially get you to where you want to go a little bit faster. Your fixed income is like your shocks.
Okay.
They can help to buffer out that volatility in your portfolio. So it's a good idea sometimes to have a component of both, because for example, right now, and I'm just going to throw out a fictional example, but let's say I had an investment portfolio and it was down 30%. I was all stocks and I was all let's say even worse, I was, and I'm going to speak for Albertans here, because I'm here in Calgary. Let's say I worked for an oil and gas company and my pension plan was in an oil and gas company and I invested in oil and gas. So right now I'm hurting, right? My portfolio is like, my whole life is kind of in a bad spot. Let's say that. And if I didn't have anywhere else to draw income from, I have to cash in and crystallize losses because that's all I had. Or I didn't diversify. And I need money right now, and my portfolio is where I got to get it from, and I have no opportunity to get it other than to crystallize losses and sell things when it's not a good time to sell. If I had had a balanced portfolio where I had, some financial institutions, some, manufacturing, some oil and gas, a bunch of different stocks and equity portfolio, but then I had also had a fixed income portfolio that really we haven't seen it go down. That has held very stable. So if I needed money, I could draw it from this part of my portfolio while it was still in a positive position and not crystallize any losses. So when we talk about diversification, we're talking about, cross industry, cross geography, and then cross types of investments, right? Yeah.
That makes sense. So those three areas. So that's good to know. That's great to know. Industry, geography, investment.
Yeah.
Okay.
Yeah. So I wanted to also talk about, while we're on the subject of diversification, and we talked about the two ways, the equities or the fixed income. You want to have a component of both of those. And then I believe that people had wanted to talk a little bit about different pools of money. So RSP, tax-free savings account. Did we want to go over those?
We did. Can I just jump back just the way my brain is wired right now? When we talk about diversifying, does that also include diversifying across different markets? And you're freezing, so I hope you could hear that question. And that might be me who's freezing here. Are you okay?
You're frozen for me.
Okay, sorry. Okay. So sorry, the question was the market. So these stocks trade on different markets, right? Like it's like different shops for the stocks. Is it important, do you think, to diversify across markets as well?
You mean like if you're in the TSX or the Dow or whatnot? Yes. I mean, I don't know that that's as an important of a part, right? I think it's more, I think it would be more important that you are, one, understanding who you are as an investor, and that's the route that you want to go, that self-investing route. Yep. Are you really at that point? Or do you want to perhaps start somewhere where you're in a more diversified and a basket sort of an investment where you can have that diversification? And in my experience, it also has to do with how much money you're deploying into the market.
Okay.
Right? Like the capital that you're deploying. It's hard to say, oh, I have $1,000 and I want to go and build a stock portfolio. And I want to go and put some, because you just don't have enough capital to buy enough stock to be diversified.
How much is enough capital to get started?
Well, I don't want to put a number out there. It would be
Okay.
different for different people. And I also don't want to discourage people if that's what they feel that they want to do. So I don't want to put a number. I just think from my perspective that it's hard to be diversified with,
Right.
$1,000, right?
But you could start with 500. You could start with 100. You could start with any number.
You can start
Okay.
with whatever you want. It's just my concern would be, the diversification ability, the ability to diversify.
Okay. So we are getting a question. Maybe you and I can talk about this after and post the question or post the resources, but books or resources that you can recommend to have more control and understanding. Anything pop to mind right away for you on that?
I can post some resources when this done. I'll go through and just take a look at what I have and
Okay.
yeah.
I had to bring this out. Are you familiar? Maybe you can't see this. This is Chicks Laying Nest Eggs by Karen Housley.
Oh, yeah. I've heard of it. I haven't read it yet.
I was hoping Jolie would be on the call, but this goes back to 2003 when there was a group of, I think it was about 10 of us in Calgary that started our own Chicks Laying Nest Eggs group, and it just kind of walked us through that. So I'll post that, but that was a lot of fun. So coming back, my analogy, and I know a lot of women might identify with this, it's kind of understanding what store you want to shop in.
Yeah.
Right. And maybe you're decorating your living room. So it doesn't really matter what shopping mall you go to, as long as you know the store is there and you understand the quality of the store.
Yes.
Right. It's kind of what I'm hearing.
That's much more important. It's much more important that you understand. And certain malls have certain stores, right? We all know that. We know the mall that we want to go to that's a little more of a high-end mall, and the one that's like maybe the bargain mall. Like, for sure, there's different kind of context there, but it's much, much more important that you understand the store and what's inside that store and how the quality of it is. That's much, much more important, right? Because that's what you're going to be wearing every day.
Got it. So you started touching on this. So let's talk about the baskets and the ETFs and the index funds and the mutual funds. What are those baskets? Like, how do we start bundling stocks?
So basically, I wish I had a picture of this because that's easy. I usually draw it out when I'm meeting with people to describe this. I should make a slide about it. So basically, if you looked at a stock portfolio, if you can envision, a big circle with little dots inside of it. Okay, and those little dots are each company that you own. That would be a stock portfolio, right? That's one way you can go out. But maybe you have $100,000 and you can buy a little bit of this one, a little bit of this, a little bit of this, and you can diversify, and that's great. And I'm not claiming that $100,000 is the number. I'm just throwing that out there. All right. Push that to the side. Now, what is a mutual fund? A mutual fund, you own those same companies, perhaps, and what it looks like is more like a pie. So it's almost like that pie that I showed earlier, how it was all those different sectors. Mm-hmm. And so what you own is a big basket with all those equities, all those items inside of it already. And then that's often managed by a portfolio manager who is deciding what stores she's going to go into and what she's going to buy, kind of on your behalf, because she has that knowledge, right? She has the knowledge of what store you're going to go into, what store is about to make a lot of profit, what store isn't, where to harbor some safety. And in that basket, that mutual fund, you might also have fixed income. So your $100,000 is kind of deployed nicely and managed for you inside that mutual fund. So it's a great way for people to start getting comfortable with risk and return. If they have, it's an opportunity for people that maybe don't have that large enough of capital to deploy a diversified strategy themselves, to invest and sort of get comfortable with it.
It's kind of like a personal shopper.
Yeah, it's like a personal shopper for sure. Somebody's helping guide you of what to wear, what to buy, what not to. Yeah.
And anything we need to be aware of when we're looking at fund managers. I know a lot of people talk about fees and watching the funds or the fees that are attached to funds. Anything to watch there specifically?
Yeah, certainly. Generally, for a mutual fund, you're going to purchase that through a financial institution, right? So a bank, an institution like IG Wealth Management. There's also private financial services institutions as well. You'll work with an advisor who's going to guide you. You can then look at different fund companies. You know, we've all heard, you know, there's Fidelity, there's Mackenzie, there's Pangora. I mean, there's tons and tons of different companies. So it's doing a little bit of research, because those companies, like every other business, have ups and downs. Mm-hmm. And those companies have good years and bad years, and good fund managers and bad fund managers. So you also want to work with people that are performing well in their industry as well. So you do want to do a little bit of research. I mean, that's where an advisor comes in. Right. That's my job, is I do that macro planning for my clients. And I say, well, first of all, my process is, who are you? Tell me about yourself. What is important to you, and what are we trying to accomplish here? I never take a dollar from a client without understanding what that dollar is meant to do. What do you want this to do for you? When do you want to use it? Those are very, very important things to understand first for me, because I need to understand where it is that we are going. That's the very, very first step. So once we understand that, we know where we're going, we know what this dollar is for, then we can take a look at what is a good place for us to put it.
Beautiful. Okay.
That's when I was talking about that financial alignment, Tanya, you and I kind of had that. Yes. I think it's very important for us to really understand what kind of an investor we are. And that's very much based on our experiences with money, our thoughts and our feelings. Those things can really deeply impact the opportunities that we take or don't. Mm-hmm. It impacts the compromises that we make with ourselves, because we know on the day-to-day we are constantly faced with choices, and sometimes we compromise. I mean, I think COVID has taught me that more than anything else on a day-to-day basis. Do I go for that glass of wine at 4:30 now? Or should I wait, right? So we're constantly faced with these decisions, and our money is the same. What should I buy? What should I spend it on? I think staying home, I've noticed, I'm not spending any money, right? Because it's those little purchases. And so sometimes understanding our longer term goals can help navigate us and steer us in that direction.
Yeah.
I got off a bit of a tangent there, but. Yeah.
No, but I think what's important there too, just to point out for the listeners, is that and this is the work that I love doing, and why I love speaking with you on this, is because 95% of our decisions are actually coming from our subconscious. So we think we're making decisions, right? But oftentimes our subconscious just wants to keep us in a state that it is familiar with. So really showing up powerfully for yourself to kind of weigh everything that you're doing, and is this serving me, or is it not serving me? Is buying the pair of shoes serving me, or is buying stocks in Manolo Blahnik serving me long term, right? So this is where you need to show up for yourself powerfully and really make conscious decisions as to where you're putting your money, what it's doing for you, and to Audrey's point here, what is your long-term goal? Right? Because that's where our decisions should be driving us ultimately. So
I'm just going to share a screen
on
that topic.
Let's do it.
So, investment planning and managing your portfolio is very important. Okay. It's extremely important to make sure that your money is working for you. So whether that you're going to do that yourself, or you're going to hire somebody else to do it. And we will, I noted your question about fees, and I do want to talk about that too. So while that's very important, right? We want to make sure that our money and our investments are working hard for us. But it's not everything, right? There's a lot of value in creating a wealth plan, right? That's very much synchronized and aligned with you. And what that does is it focuses on meeting your needs today and meeting your needs in the long term, right? So we need to look at managing our cash flow, structuring our debt efficiently. What that can do is maximizes opportunities for us today and in the future, right? Because everything's taxed differently, everything's withdrawn differently, and we'll talk about those pools in a minute. Mm-hmm. You have to plan for the unexpected, like what we're in right now. There's health and disability risks, and your plan can get derailed. So you want to build in that element of protection, right? into the plan. You want to optimize and test out your retirement plan. Having this, I mean, a lot of people have this theoretical line that, I want to have $1 million to retire. And if I backtrack, I got 20 years before retirement. So I need to put away X amount of dollars and invest it at such a rate of return. Well, life isn't a straight line. There's going to be market corrections. There's going to be potential health issues. There's going to be potential. So we have to make sure that we test that retirement plan, that it will survive many different, those derailments that could happen. We have a plan for.
This is the work you do. This is the work financial advisors do, is really acid test it, right?
Yeah, definitely. You want to plan for the other goals, because I don't know about you guys, but there's a lot of stuff I want to do before I retire. So though it's an important goal, I want to be able to retire comfortably and safely and be able to be healthy in those years and enjoy them. I also have other stuff I want to do. I want to take a couple vacations. I might want a new vehicle between now and then, right? So, we got to plan for those things as well. And lastly, you can see on there that it's called sharing your wealth. It's a nice way of saying, one day I'm not going to need it anymore. So you want to create a legacy plan that really ensures that your desires and your wishes when you leave this world are fulfilled. And you want to fulfill those in a tax efficient and meaningful way. So outside of just investing, there's all these other financial components. And I feel like working with somebody, a coach, is really important in those ways. Because every decision that you're going to make across these 6 areas of your financial life is either going to create a challenge for you, or it's going to open an opportunity, right? And it is only through having this alignment, this comprehensive plan that surrounds you, that you can really achieve, your full potential.
Right.
Yeah.
Right.
So
I know
that's an important piece too.
Yeah. And so when people are coming into the matrix, the 5 pillars that we work on are the investment pillar, the savings pillar, the sharing pillar, which also in our world is taxes, but it's also about what are you doing right now. So I love actually the piece that you're layering on here is like, what is your legacy? Like sharing your wealth forward, at the end and planning for that. So that's a brilliant component that we've never tied in there. We do talk about debt repayment, and we talk about our spending, right? Your typical financial literacy pieces, you're spending on needs, wants, and then our splurge. One of the things I'm curious, and then obviously as we figure out all of that, that then influences what we actually need to be earning. Because most people are hiding from that number and doing what they can with what they make instead of actually knowing what needs to be done and then making accordingly. The tax piece, the tax strategy, is that something that you or financial advisors also plan for? Or is that when we bring in an accountant? Or do the advisors actually look at that as well?
I do in my practice, and I can speak to myself and most of the colleagues that I know do tax planning. All right. So what I would look at is I will look at what are your investments in and what are the tax implications there? What's your job? How can we structure things for tax success and efficiency? And so it's a huge part of what I do for my clients is ensure that they have that tax efficiency built into their portfolio and built into their life. And then I work in a collaboration with accountants and lawyers and all those other professionals. So I kind of say it's like a wealth spa. Right? You want to go and you want to create a wealth spa for yourself. You got someone who's helping you with your nails and she's your nail girl, the hair girl. You really want to have the built-in professionals around you that are going to help sort of around those 6 areas of financial planning. And so I often feel like I'm at the center of that with my client and helping to sort of touch point with all of those people and make sure that all of those areas are kind of being handled and being managed efficiently and together, right?
Beautiful. So we've got a question in here from Helen. I'm going to ask you one question as we jump into this because it's a good segue. And actually, Helen, if you can wait one more moment while I ask one other question on taxes, because we're just on taxes. So just to kind of frame this out, question number 1, do you facilitate building those relationships? So if I'm coming in and I'm looking at starting investing, do you help me find the lawyer, the accountant, do you champion that, or is that still up to me to find those people?
I have, like I said, I have created for myself and my clients a wealth spa.
Beautiful. So
I
you
have a number of, I have several accountants and several lawyers and professionals that I work with really well, and I trust them and I like them, and I hear great things from my clients, so I keep using them, and we go out for lunch, and we have a good relationship, and I think that's very key. Anytime you're working with any professional, I mean, when you go to get your hair done, you go back to the woman or the man or whoever it is that's doing your hair that you like, that you trust, and that did a good job for you. So I think it's important to find those professionals. As an advisor, most advisors that I know have a team or have some referrals that they can hand out to you.
Beautiful.
I certainly do in my practice. I love connecting people that I think are going to be a good match. Maybe I would have been a good matchmaker in another life. I don't know, but I love that networking component of what I do. But if I encounter someone, like say that you came to me, Tanya, and you said, I have this great accountant that I love, I'd be great. I'm always up for meeting a new one. So it's really up to the client and what they want, what they have, and what they know. And I can always help guide them if they need support.
Well, and just so everybody knows on the call or listening in, there's huge value in that, because if you've been a business owner, if you started a business, knowing to even just get all of those resources, your lawyer, speaking to your accountant, speaking to like that can be painful. So to have one person that when you build that relationship with the advisor and you trust them and they're able to introduce that circle to you, that is, that's extraordinary. So good to know there.
It's extremely important that your accountant and your financial planner talk to each other.
No doubt. No doubt.
Very important. And in this day and age, becoming more and more important. And I'm going to talk about why actually right now, unless there was a question.
There was a question just on how we find a financial advisor. Like how do we, because they're not all equal. So what do we look for and how do we go about doing that?
Okay, great question. I have, I hand out this sheet and I'll share it here and I'll provide it to Tanya later if she wants to send it out. This was put out by the Globe and Mail. Can everyone see this? How many times did you say yes?
Yes.
Great. So this runs through a few questions that you would want to ask yourself. One about your current advisor if you're working with one, or when you're going out to interview, you can phrase these questions in a way that's asking, do you do this, right? And then after a while of working with that person, you're going to want to evaluate them, right? So these are some of the ones, I hear from them at least once a year. That's a pretty bare minimum. I mean, I talk to my clients way more frequently than once a year. We sit down for a full, thorough annual review once a year for sure. But I'm calling them every quarter and I'll see them as much as they want to see me. I have a copy of my financial plan. So a lot of people think that their investment statement is a financial plan. Your investment statement is an investment statement. It tells you where you are right now. Perhaps your rate of return, so where you've come, but that's it. That's all an investment statement tells you, is where you are now. It has nothing to do with where your investments are going to go. It doesn't talk about your taxes. It doesn't talk about your estate plan. It doesn't talk about your cash or your debt. Those 6 disciplines, those 6 areas.
Sorry, Audrey, you cut out.
That's a very important thing. I think the statistic is that only 50% of Canadians have a will, personal directive and power of attorney. Your financial advisor should help navigate that process for you and should have one on file for you. My consultant has clearly explained the cost of ownership of my investments. So I do fee audits. What are you paying? What are you paying me for my advice? Because there is a cost to working with a financial planner. I love what I do, but I do, it is my living. It is how I make an income and fund my family. But I make sure that my clients know exactly what that is. What are you paying me? And what are you paying for your investment? What is the cost of that mutual fund or that ETF or that stock or that whatever that you're going to own? What are you paying to own that? Because that's an important thing, and you should have a fee audit. It should be broken down for you, and you need to be comfortable with what you're paying and realize that there is value in that. And if not, if you don't think that there is, then maybe that's something that you need to analyze.
So just to clarify on that statement, there are multiple layers of fees, right? There's the fee for the advisor. There's the fee for actually buying the fund or whatever it is, or the stock. So yeah, getting a very clear breakdown of where all those fees are, because those can quickly erode your return on investment, right? Once you start calculating all of that. But your financial advisor will help you with that, right?
They should be very clear and upfront about what you're paying.
Okay.
And it's very frequent that I mean, the financial services industry has a bit of a bad rep for this, for hidden fees. You know, I tell my clients on a dollar amount what they paid me in a year. This is what you paid me. Do you think that you got this much value out of it? Okay. And I have nothing to hide that way. This is the value. I feel very confident in the value of my advice and the cost, what I'm charging for it. Okay. And I often will go through and say to them in our annual review or our fee audit review, I'll say, this is what I did for you. This is what I charged you for it. And this is ultimately what it resulted to for you in terms of a dollar amount. I saved you by our tax planning and our restructuring your investments, you know, $10,000 in taxes this year, and I charged you, you know, $2,000 in fees.
Okay. Is that something that you would expect to see annually or quarterly? Just kind of breakdown on return and fee attached?
Yeah. Yeah, we do that. I do annual fee audits so that I make sure that my clients know what they're paying. Okay. Right? And it's presented in a dollar amount on the statement. Another important one is just above and below that, helps me improve my financial habits. That's one of the biggest jobs of that I have, is cash flow and the debt management, and just helping improve habits, making sure that every year you increase that amount that you're putting away. I'm sort of that, you know, that voice in your head. Did you really need to buy that? Right? It's my job. My job is to remind you what your goals are. Because that's what, ultimately, that's how we can change our decisions and change our financial focus, is being reminded what our goals are. I think sticky budgets that say, you know, you're only allowed to spend, you know, $200 a week on, you know, your coffee and you're eating out. It works for some people, but not for everyone. For myself, what works better is saying, I am envisioning myself on the beach in Mexico when we're allowed to fly again. And that's more important than my $7 coffee. Mm-hmm. I want to save my $7 for the beach. You know, so it's changing that mindset and telling you what you are buying instead of what you're not buying. Okay. So that's a good job of financial advisors to help change those financial habits.
So are you suggesting then, Audrey, that we look at this list and these are some of the questions that we would then ask of potential advisors if we're shopping around for one?
Yeah, I think this is a good scorecard, right?
Okay.
Yeah.
Okay. And are most of them would be comfortable answering these questions?
If they're not, I think maybe says something there. I would be comfortable answering all these questions.
Okay. And so I know you said that you would be open to, because we've had a number of members that have expressed interest in getting into the market themselves to just get a little bit more comfortable with it before they approach a financial advisor. Yes. What would be some of the steps to actually, if somebody had right now $1,000 and just wanted to get a sense of how the markets worked, how to apply that money, what would they do? What's the best way to go about that?
If they wanted to buy stocks on their own?
Yes.
Yep. So you would have to pick one of the self-trading sites, like you know, there's Wealthsimple, you know, one of those. Okay. Open up an account and then pick the stock that you wanted to buy and hit buy. I think those sites have been designed to be very easily navigatable by people. So I think that would be your step. You know, I would recommend seeing an advisor before you did that.
Okay.
And just, I mean, consultation with financial advisors are free, right? You go in, you can get a consultation, and they're not going to charge you to go in and talk to one of them.
So even through COVID, is that still happening?
It might be that some advisors are very busy right now. So okay. I suppose it could be more challenging right now, but generally speaking, I mean, having a little bit of a conversation with somebody before you decided to do that, and investigating, for sure you want to investigate the company that you're wanting to buy.
Right.
Right? There's
Okay.
lots of online resources as well. I think those trading sites also offer some support on them. I don't invest through any of those, so I'm not too familiar, but I think they offer a little bit of support as well.
Okay.
And you're going to want to pick what vehicle you're investing in, what pool. And so I'll talk, that was the last thing that I really wanted to share. And this impacts your tax, how you're taking the money out, et cetera, et cetera. So I'm going to just share my screen with that.
While you're doing, can I ask you 2 quick questions that came up?
Sure.
So financial advisors still do meet with new prospective clients right now, even through COVID. So it would probably be a virtual meeting or a phone call as we're doing. So that is still happening. And then we had a question with respect to financial advisors. Are they licensed from province to province, or can somebody in Saskatchewan call you? How does that work?
Yeah, so as an advisor in Canada, how it works is that we are provincially licensed. So you can, as an advisor, get your license in any of the provinces or in just the one that you live in. So that's each advisor would be, make a decision about where they would want to be licensed and where it was beneficial for them to be licensed. It is an additional cost to you as an employee, as a boss or as the owner of your financial planning firm to license in each province. But if you had clients there or prospective clients, then it would be, and it was beneficial, then you could get licensed across the country.
Perfect. Okay. Thank you for clarifying.
Yeah. And I onboarded a client earlier this week. So I'm still business as usual. COVID is not going to stop me from helping people. It's just virtual meetings. I mean, we live in this digital world. I have access to, we can get signatures through DocuSign. We can send forms. We can email. We scan. There's nothing, there's really nothing that we can't do right now.
Okay.
We can
Good
share
to know.
screens, so I can go over charts with people. So it's, yeah.
Beautiful. And sorry, before you move into this pool of money, I just want to come back to one of the earlier things you said, where we had talked about the 35% decrease that we've seen in markets overall. There still is, as we speak right now, there still is an opportunity, correct, to acquire stocks at a discounted rate, right? We certainly haven't climbed back up.
No, we haven't climbed back up yet. And so there's always an opportunity. There's always an opportunity in the markets.
Okay.
Right? That's what it is. It's always an opportunity. Right now, it's a great one because things are at a lower cost. Good companies are on sale right now.
Okay. Right.
If you think about here in Canada, some of the big names, Air Canada, right? Or is that, is Air Canada going to go under? I don't want to totally comment on that, but there's no chance, it's going to return, right? So,
yes.
So we look at that, right?
Okay.
So pools of money are, again, different. I don't want to use the word vehicles, but I guess you could, vehicles to invest. So when we think of where we're going to, what kind of an account we're going to use to deploy our money, basically we could do that through a non-registered account, a tax-free savings account, or an RRSP. So I don't know how familiar people are with those 3 types of accounts. A lot of people think that a tax-free savings account is an investment, but it isn't. It's just a wrap around your investments. So you can hold GICs in there, ETFs in there, stocks, mutual funds. You can do your own investing. You can see in a financial advisor or go to your bank and they can open a tax-free savings account for you. It has nothing to do with the type of investment that you're holding. Rather, it's a wrap around it that the government has put around any kinds of investments that you hold inside there. Mm-hmm. And they're treated differently for tax purposes. So that's what those 3 wrappers are. So you can envision there's an RRSP, a registered retirement savings plan wrapper, and any investments that you hold in there are registered with the Government of Canada, and they are treated differently for tax purposes. Then there's your tax-free savings account wrapper, and you can invest whatever you want inside there, and those are treated differently. and then there's a non-registered investment. So do you guys want to go through what those are and how they're treated for taxes, or?
I think we're okay. I think just, high level, where the RRSP is mitigating your taxes in present day dollars,
Yep.
right? And your TSFA, your tax-free savings account, is mitigating your taxes at the time that you choose to cash in on that investment. So you're lowering your taxes then. Those are really the two big pieces, right? Either lower your taxes now if your income is high, or lower your taxes later if your income is high later on. And I think that where a financial advisor can really kind of dial that in based on what your wealth plan is extremely invaluable. Because I forget what the number was. I think I heard it at some point, and correct me if I'm wrong, but over 65% of our income is actually applied to tax dollars. When we look at provincial tax, municipal tax, GST, HST, property tax, like it all just, a lot of it goes out. So if we can start to fine tune where those dollars are going and really take advantage of these tax instruments, that would be huge.
Yeah, I think that tax planning is probably one of the most important things that we can do for ourselves in our financial picture, because it really is, where you're going to get the biggest bang for your buck. Okay. That's where you're going to make your money back, right? So I'll share this last slide with you here. Did that go up there?
It did, yes.
So this is something that was put out from a survey that was done by Morningstar. And Morningstar is an independent. It helps people with investing. It helps to rank stocks and mutual funds and gives them a star rating. And so what they said is, where does people's net worth or overall performance and improvement in their life, in their financial life, come from? And so they said, well, about 5 to 10% comes from alpha. That's that dark blue, that letter alpha. And what that alpha stands for is picking the right stock. Was it Apple or was it Samsung or was it, so that's what alpha is. So 5 to 10% of your overall growth and overall net worth accumulation is going to come from being a good investor and picking the right stock. 20 to 25% of that overall growth is going to come from beta. What beta is asset allocation. Were you in stocks? Were you in fixed income? Were you in the right place? That diversification piece, right? So that's very important when you're building your portfolio, because 20 to 25% is going to come from that. But they found that 60 to 65% actually came from what they refer to as gamma, which is good decisions, good tax planning. Were you in the RSP? Were you in the TFSA? Did you do that? Did you manage that correctly? Did you have some non-registered? Did you consider your CPP and your OAS and your pension? And where you're going to be taxing, how you're going to be taxed from those? Did you have proper insurance so that your plan didn't get derailed? So you can see from that survey, they really say that holistic planning is really where you get your most value from.
Beautiful. Well, yeah. So, that's so important. And, thank you for sharing that, because I think that oftentimes we maybe tend to oversimplify the investment process. We think, well, you just buy a stock. And what I'm hearing from you here is the complexity of pulling all of this together, to having the plan, understanding where you are now, where you want to be, how to diversify across different landscapes, right? And then how to make sure that's protected, and then layering onto that the tax decisions, the insurance decisions. So thank you for that. There was tons of value in this, Audrey. Thank you so much for being here and kind of breaking that down for us, simplifying it. I'm hearing you say that you are taking new clients, and then you're open to any conversation regardless of where people are calling in from.
Yes, definitely reach out. I can post my email. I'm on Facebook, I'm on LinkedIn, I'm on Instagram. It's pretty much my name in any of those capacities. So look up Audrey Veltri and you'll find me. And like I said, I'm never too busy to take a phone call or to give somebody some direction on where to get started. And, you know, though this is such a complex and overwhelming piece of our life, you know, and it can feel very heavy at times. We just take steps, right? And I think that it's important for people just to get started. So, you know, I don't want to, I don't want to make it more confusing for people. So if your objective today was to get started with an investment and you feel confident in a company and you want to move forward with that, do that. But I would also recommend that at some point that you get a coach. Because I think that anyone who's been successful in this world, I mean, you look at Oprah Winfrey, she's super successful, and she's had coaches, she's had support, she's had people that helped walk that journey with her, and she supports the concept of having somebody alongside of you. She knows that that's the only way to get to the end the most successfully. I think we need coaches in all areas of our life, our health, our wellness, and our money's no different. And so working with somebody or getting some advice is a great way to get to the end a little bit more efficiently.
Beautiful. Well, you bring up a really good point there, which is asking for help. And I know that a lot of our members that are going to watch this, they resist that, right? There's the armor where a lot of people feel like they need to be able to do it on their own to prove validity, whatever it may be. And so this is the time to start reaching out, asking people for help, because there's lots of help out there. You don't need to go it on your own, and you'll probably expedite your results, right? And you'll pay off a lot faster. So thank you, Audrey, for that. So appreciate you being here. For those of you that are here now, know that we are going to post the recording. Audrey, it sounds like you'll also share with us some of the slides, so we will get that in there as well. And if you're open to it, I'll share your contact information in the post so people don't need to try to find you on their own, to simplify it and make it as streamlined as possible. So thank you for joining us in the Matrix today with Audrey. We'll have the recording posted for you shortly. I'll be emailing all of you that registered for the call, so you know exactly where to find that. And we will see you again next week in the Matrix. Thank you. Thank you, Helen. Thanks for joining, everybody. Bye for now.
Bye.